Hi everyone, in this video I'm going to answer the question if EPR Properties solid dividend yield of nearly 8% is safe. I know a dividend yield of 8% is very attractive to passive income investors considering treasury bonds are paying less than 4% if you're going out 10 years in duration. And so investing in a company that can deliver almost 8% dividend yield is extremely tempting. So let's go through a few metrics and briefly look at if this dividend yield is safe or not. The first metric I'm going to look at is the dividend payout ratio. The dividend payout ratio measures the percentage of its earnings a company pays out in dividends. Now, if you're spending more on dividends than you're bringing in earnings, that's arguably unsustainable because eventually you're going to run out of savings and borrowing capacity, and you're going to need to bring your dividend payment down into balance less than 100% of your earnings. And looking at EPR's dividend payout ratio of 107.6%, it is in the dangerous red zone category of being above 100%. Now, for a brief amount of time, it can sustain this, but longer term, this needs to be below 100% in order for the company to sustain this payout ratio. Now, you saw a major fluctuation here in 2020, and that's because the company is exposed to some away from home entertainment categories, mainly movie theaters, or it's got heavy exposure to AMC movie theaters, Cinemark movie theaters. And so when the pandemic hit and rent payments from those companies fell, and that caused its own revenue and earnings to fall, which caused its dividend payout ratio to exceed 100%. Now, another thing I like to look at is diluted earnings per share for the trailing 12 months. This gives me an idea of where earnings are going. Are they rising? Are they falling? Are they stable? And for EPR Properties, going back all the way to 2014, we notice a healthy, stable, and even growing earnings per share. That is until the pandemic hit and its properties, its rental, its the exposure it has to the properties cratered, and now it's bouncing back in a V-shaped recovery, but you notice it's still at less than where it was before the outbreak, and there is no telling if it'll ever go back to that level. If we're looking at the movie theater segment specifically, it's movie theater properties. If I go back and look at movie theater ticket sales going all the way back to the year 2000, you could see a steady decline in that trend. Movie ticket prices are rising. The cost for a family to go see a movie has soared in the recent decades. Meanwhile, you can get a streaming subscription for less than $10 per month that can entertain your family all month long. While going to the movie theater, a price for one ticket has exceeded $10. Popcorn is $9, soda is $7, and so that cost versus benefit equation has strongly favored staying at home to watch a movie versus going out to watch a movie. Now, in the near term, there may be some pent up demand to go out, and it could recover its earnings per share back to pre pandemic levels, but in the longer run, I fully expect this to be a headwind for this company here. Now, of course, when you're dealing with real estate investment trusts like EPR, another important metric to look at is funds from operations. And again, similar to earnings per share, you see a nice steady increase in its funds from operations from 2014 all the way up to 2019. Then we saw the major crash in 2020, and now we see the bounce back recovery, but still not up to the level it was before the outbreak. So several metrics we considered here, and the main theme we take away is that this company's business was highly exposed to businesses that faced significant drawdowns from the pandemic, from people going out and and spending time away from home, that's coming back, but you can see here that it's not coming back to levels before the pandemic. And you can look at box office revenue, you can look at several different metrics that will show you that yes, this industry, the away from home industry, is bouncing back strongly, but it's still not recovered above the levels from before the pandemic, and it remains to be seen if it ever will recover to those levels or not, because structurally so many things have changed since because of the outbreak, right? So overall, if I had to answer the question if EPR Properties dividend yield of nearly 8% was safe, I would lean towards answering no, that it's not safe, that it doesn't have sufficient earnings to support that dividend payment. And unless its business recovers strongly to pre pandemic levels or higher, this dividend payment is in question, is in jeopardy. Now, it's not going to be completely in jeopardy. It's not going to go to zero. I'm not saying that, but it might need to be reduced. It might need to maybe no more growth. It might need to stay at the same dividend payment for several years more. So investors will have to be satisfied with the current dividend payment going out several years. And so if you're interested in EPR Properties for that dividend yield, I would say to be cautious. I would say to be cautious. All right. So thank you for watching this video. That's all I've got, and I will see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.